Good morning, welcome to the market view for Wednesday the 11th of June 2014. And starting off with the 30-minute chart, we can see yesterday morning we had a buy signal at around 7:30. This didn't materialize in a trade being filled, and then the market switched and offered a potential sell. The market moved lower, and as I said yesterday, we only had the manufacturing figures out. Not too much of a concern, except for, of course, it was a slow news week. But the market moving lower, filling the trade, and then reversing and coming back. And the risk on this trade was only 20 pips because of the narrow range on this market at the moment as well. And even had you have moved the stop just above the high of this bar here at 8 a.m., then the risk would have only been about 23 pips as well. If you wanted to wait for the weakness to confirm itself following this signal and the news, we have a red bar here, and you can always tuck underneath these as well after the news has been released into the market. Look back to the previous signal, and then when you see either strength for the up move or potential weakness for the downside, i.e. another red candle, then you could always use this as well. And this, of course, would reduce the risk as well. And what I mean by this is the markets move lower, turn around, come back. We have a signal to the upside. This has not been filled. And then we have a red candle, and you can see there the risk is now 10. The entry price is also a lot higher as well by 5 pips there. But let me just remove this one and assume this trade to the downside, the market coming back and then moving down to the scalp target there, the first profit target, and then we get a green candle, and using the 50% rule above the green coming into the market takes us to more or less break even. We get a second consecutive green candle. This is not filled. There's a third one there. We have another one here, and you can see what I'm doing is just moving down with the market, letting it tell me what to do, and then eventually the market stops out the trade at 16751 within that area, and thereby offering a potential of fully on the trade down to the low here is 48 pips, so still a fairly quiet day. And then from the entry price to where the stop was, the rolling stop is 39, so just 40 pips there for this trade, which took all day to actually move lower, and that's because there's not much news around in the market at the moment. So let's have a look and see how this fares in the daily chart. You can see that the market has pulled back to the 62% areas here from the recent highs. And in fact, I will just redraw that for you because that doesn't look quite right to me. So let's just redo this. The first will be from here to here, and that's more like it. It's got to be 76%. The market generally steps within the 76 and not the 62. So that makes sense now. So we've gone from the high to this low. We're rolling back the fib there, and then from there to there you've got 62 now with the 76, which makes sense, and then the 76% where the market headed towards 167.331, which has been made on the overnight at the moment. So today we have the unemployment figures out, which I will come to you in just a second, but let me just mark up some potential upsides here. So we'll go from here down to, could do with going to the low of this bar, but it won't let me draw on it because the market's trading in real time on this bar. So I'm just going to go to this one, and it's sort of back towards the 168 level is where there will be some sort of resistance there. So today's figures, I would this sort of range today, if the market moves lower and takes out the 76%, then we're heading down towards the 167.50 at the moment, where we're finding support, and then 168 on the upside. So this 100 pip band here is where you'd expect the market to trade. In the news, we've got unemployment rate, and we're forecast to be down to 6.7, which is interesting. As I've mentioned before, Carney, the former Goldman boy, was going to increase interest rates if unemployment dropped below 7%, but of course he's reneged on that, just like the rest of the politicians when it comes to actually actioning what they promise. It never actually happens. So it'll be interesting to see if this figure comes out at 6.7. That's going to put more pressure on the government to consider raising rates, as they say the economy is turning around. So they're painting themselves into a corner with what they keep actually saying they're going to do, and then they're actually following through with it. Claimant count change at 9:30 as well, minus 25k forecast. The same there. And then at 2:45 this afternoon, we've got Broadbent speaking, medium impact news item there, and then actually nothing from the US until 7 p.m. We've got the federal trade budget balance there. So let's have a quick look at the Dow implied and the Dow chart, and also somebody's asked me if I'll have a quick look at the FTSE 100 as well, so let me just sort that out for you. So in the Dow implied, we can see that this moved slightly lower again yesterday, no doubt going to retest the lows that we actually see, or what we've had during the last few weeks. And again, the historical volatility dropping down as well. You can see how when this has happened, it's been a precursor, along with the lows in the implied volatility, where we actually get a correction in the market. Just have a look at the Dow chart. That's the monthly chart. You can see we've got this move to the upside. There's completely no awareness of risk anymore. The market can't crash, just like it was in 2007. I'm going to come to that in just a moment, but let me just drop this down into a daily chart so you can see what happened during yesterday. We've got the market moving high. We were sideways to low yesterday, but again, the market coming off the lows. Every time the market moves lower during a session, the market comes back in. Again, if you look every day for the last few weeks, even though we've got a bit of a sideways move here, the market has come off the lows of the trading session. This is a classic distribution phase of a market where they are sucking the general public in. As the market moves lower, they buy back. This gives the perception that everything's fine. There's no risk to the downside. It will never crash again because the government will continue to print, etc. And they keep bringing the market back up, and then are able just to offload to all of the sheep. So that's what's happening there at the moment. Expect 17,000. I wouldn't expect any correction until that really takes effect, because that's where the next sort of big round number is for this market. With regards to the FTSE 100, this is the monthly chart of the FTSE. You can see that the lows of 2007 are breached. We have the highs now having been taken out, and if I just reduce this size, you can see we're not back to the all-time highs. You have to go back a bit further to let's have a look, 1998, and there you can see you have 6995, and that's before the tiger economies got into problems. And then of course we had the 9/11 event, and then of course Bush and Blair decided to have an illegal war in Iran, and then you see the market move higher as they printed money in 2003 all the way through to 2008. We're back at this level now. This market's moved up on printed money. This is when they printed money and we had the toxic mortgages, back to where we should be, in my opinion. And then we've seen the market rise again there on funny money. So that's what it looks like as far as the FTSE is concerned. Triple top situation, as it's known in technical analysis. And one other thing I just wanted to bring to your attention, I mentioned this yesterday. It was last time this happened, the financial crisis broke out. Well worth a read. Having read this yesterday, the Fed have a financial stress index, and basically what it's indicates is that, again, this thing of nobody really sees any risk in the market, and you get this no stress, lots of stress is how you read this chart. And you can see now we're down back to the sort of pre-crash lows all the way through 2000 and whatever, because of the Iraq war and whatever. There was always volatility and stress in the markets. This disappeared as Bush went on a printing spree with the Federal Reserve, and then handing out mortgages to people who couldn't afford them and whatever through Goldman, who managed to short sell that market then just before it all broke out. And now we're back to these same lows. So the stress index is showing a negative, and that for me indicates that, again, just combined with the lows in the implied volatility, lows in the VIX, which is the volatility index that is also mentioned in here, that too is at historic lows. And for me personally, this makes absolutely perfect sense. You've got a market that's gone up on QE money, not on real growth. We've got junk bonds flying around buying back company shares and stock. So for me, it's just a matter of time before, again, the picture reveals that we are in for a major correction in the markets. And there's this sort of, at the moment, this apathy that the market really won't correct. You know, everything's fine now. The government sorted the banks out. Not so. Do the research on that one. You'll find the banks are not out of the woods. So it's just a matter of time, and unfortunately that's the only thing I can't give you is the actual date. However, that's just jogged something else that I was asked about with regards to getting into the market when these do break, just in case you miss it. So let me just wind the clock back a little bit for you here to February. I'm just going to remove these lines off the chart. Let me show you the implied volatility in January. You can see we were back down in these levels, and then the market corrected because the implied volatility shot up, and then the market has since been moving back to the upside. Again, if you're not aware of this, there is an inverse relationship between the implied volatility and the underlying Dow Jones. So back to the Dow chart. This is January 2014. You can see this. You can see the market was trading sideways, and then we had this one day where the market just dropped. So let me just widen these bars out for you first so you can see what's going on. So we had the selling in the market. The market is bought back, and this is the interesting part here, because if you think you've missed the move, generally you will not miss the move, because the market will do whatever it can to actually come back first. So just by using a simple fib retracement, if we go to the high down to the low, and then I just draw that across, look where the market comes back to. It comes back to 76%. So even though we don't know the date and the time that the market is going to move lower, it doesn't matter, because it's likely the market is going to come back and retrace first, so that it gives the impression that all is well, and then we see the market move lower there. And by the time we get to this low, the lows here, where we've got 2 selling days followed by a buying day, the market's then retested, and then we're off back to the races as the printing takes hold. And you can see where the lunacy has taken us now. We've broken out of this sideways area, and now heading in what's sort of the parabolic melt-up phase. So just to reiterate, you don't have to worry too much about when it goes, because the market will try and bring back the prices to give the illusion that everything is fine, and then eventually you will get the market moving lower. Again, you've got this same thing there. There's a 76% retracement there, and then the buying coming back into the market there, huge buying. On this occasion, we don't get it coming back as much, and then eventually break into the downside, and the same here. But look at the selling. There's a clue there. There's a huge amount of selling, so the market is nothing else but to move lower. Again, finding support to the left, and then the market reversing. And here we get a bit of a pullback before coming back. But again, this is not coming off the multi-year historic lows off the implied. This is a different ball game. These are just small pullbacks in the bigger picture, which again, when you look at the monthly chart, you can see they're just small pullbacks. And even the February one, you can see February there, and then we're back a month later. But the implied volatility had doubled, giving us a clue that we were back, or about to move back to the upside, which we there have seen over the last few months. So that's it for today. It's a bit of a long one today, but I've had quite a few questions, which hopefully I have managed to answer within this edition of the Market View. Okay, all things being equal, I will see you in tomorrow's edition. Have a great day. As ever, thank you for your support. It's very much appreciated. And also for watching.